respected chairman, my colleagues on the dais and friends. This is a very interesting topic of relevance of legal maxims in interpretation of tax statutes. In fact, only while preparing for this, I realized that it is quite an experience to correlate the maxims which are there with the issues which may arise under the Act. Before going into the maxims which I thought may be useful for discussion, just brief background about what does one mean by legal maxims. Legal maxims are established principles or propositions which have been developed, which have been evolved, and those are accepted as such. The relevance of legal maxims is mostly in terms of interpretation of provisions or in terms of rules of procedure. The sources of legal maxims are where any civilization which would have been evolved would have developed certain basic principles of law. For example, in the Hindu civilization also, if one goes into the Vedas and other things, there would be various basic principles which would have been laid down. So that is not what I am going into. And there are certain dedicated books also which have been on this particular subject. Today, I am mostly covering some Latin maxims, and the frame is that we will take each and every maxim which I have identified. I will try to correlate it with the issues which may arise under the Act, and if there are certain decisions, I will make a reference to those. So first maxim is a verbis legis non est residendum, which means no departure is permitted from the words of a statute. Friends, this is the golden rule of interpretation, which is that a provision has to be read as it is, which is also called as the literal construction. And this is fundamental to the tax provision because, as all of us are aware, that no tax can be levied unless a particular assessee's case falls within the charging provisions. So, charging provisions have to be interpreted literally, and if you fall within those charging provisions, you can be taxed. If you don't fall within those charging provisions, you cannot be taxed. There are certain illustrative examples where this provision has, where this particular rule of interpretation has been applied. There was a decision before there was a case before the Supreme Court in the case of Vikrant Tyres Limited, 247 ITR, page 821. Section 220, subsection 2, levies interest if there is a default on the part of the assessee in paying the amount specified in the notice of demand within the time prescribed in the notice. And normally such time which is prescribed is 30 days from the date of receipt of the notice. In this particular case, assessing officer raised a demand. Assessee paid that demand within the 30-day period. Assessee filed an appeal before the Commissioner Appeals, where the Commissioner Appeals reversed the assessment order. So therefore, a refund was given to the assessee. Department filed an appeal to the tribunal. Tribunal upheld the Commissioner Appeals order. Matter went to the High Court, where High Court reversed the tribunal. After reversal of the tribunal's order by the High Court, demand was again raised, and department argued that you have to pay interest right from the point of time when assessment order was passed up to the date when the High Court order is given effect to. The Supreme Court has said that Section 220 subsection 2, when it is read literally, it says that there should be a default in payment of tax within the time prescribed in the notice of demand. So in the notice of demand, the time which you prescribed, there was no default. So therefore no interest could be paid for the earlier period. There was another case again before the Supreme Court in the case of Yokogawa Limited quite recently, 244 Taxman 273, where the Supreme Court was concerned with interpretation of section 10A, 10B, and whether brought forward losses or unabsorbed depreciation could be set off before computing the eligible profits on which deduction is to be granted. One of the issues involved before the Supreme Court was whether 10A and 10B is a deduction provision or an exemption provision. Exemption provision because it falls within chapter 3. Deduction provision based on the language of the provision. And Supreme Court has said that one has to go by the literal construction. The chapter in which the provision is doesn't matter. The provision says that deduction shall be allowed from total income, so this is the deduction provision. Also, a situation could arise as in the case of IPCA Laboratory Limited 266 ITR 521 before the Supreme Court, which was in the context of deduction to be allowed under 80 HHC. This was also a much debated provision of 80 HHC, but the issue was that under 80 HHC there has to be computation of manufacturing profits, computation of trading profits, and if the assessee is a mixed entity where there is manufacturing as well as trading, then it has to be on a different basis. So under one of the heads there was a loss, under the other head, which is the manufacturing and the trading, there was a profit. Supreme Court has come to a conclusion that the loss has to be set off against the profit, and if there is no profit left, there would be no deduction allowed. Here they have held that for the purposes of considering eligibility of deduction, a strict interpretation is to be given. However, if an assessee is found to be eligible, then a liberal interpretation so as to grant full relief to the assessee may be considered. The second maxim is ut res magis veliet quam perit. Construction which will defeat the object of the statute should be avoided. This is an exception to the golden rule, which is literal construction. And this proposition or this maxim could be applied only when there is an ambiguity in the language of the provision. When this maxim is to be applied, one has to consider what was the object behind the insertion of the provision, and the interpretation which has to be placed on the provision should be with a view to further that object. Classical cases where this particular maxim, though this maxim has not been referred to in the decision, but where this maxim has been applied, are the decisions of the Supreme Court in KP Varghese 131 ITR page 597, and in the case of JH Gotla 156 ITR page 323. In the case of KP Varghese, the court was concerned with section 52 subsection 2, which is no longer on the statute book today. There, the said provision provided that was with respect to computation of capital gains, and said that if there is a difference between the fair market value of the asset and the full value of consideration for which the asset has been transferred, and such difference is more than 15%, then it would be open for the department to compute capital gains based on fair market value of the asset. Issue arose before the Supreme Court as to whether there should be some limitation on this provision, because there was no such limitation in the section. Supreme Court went into the object with which the provision was inserted, namely that there was a realization by the legislature that there is large-scale understatement of consideration in property transactions, and therefore this provision was brought in. Supreme Court said that before invoking these provisions, looking at the purpose, the department has to show that there is understatement of consideration. Even if there is 1 rupee understatement, the department would be able to take the fair market value. But unless this precondition is fulfilled, it cannot be done. So this is one of the examples where departure has been made from the literal construction and one goes to the purposive construction, which is what was the purpose behind the provision. The second illustration, as I mentioned, would be J.H. Gotla. This was a case where assessee was an individual and was running an oil mill. Whilst he was running the oil mill, it was running into losses. He gifted the machinery of the oil mill to his wife. Wife entered into a partnership with another person and started this oil mill business as a partnership firm. As per section 64, this was under the 1922 Act, so corresponding provisions under the 1922 Act. Share of profit of the wife was to be assessed in the hands of the husband. Assessee said, I am having brought forward losses which have come from this oil mill business. I am having share of profit which is I have received on account of my wife's share in the partnership firm. One has to be set off against the other. At that time, section 70 had a requirement that in the year in which set off is claimed, the business from which loss had been suffered has to be carried on by the assessee. Department's argument was assessee is not carried on the business. It is the partnership firm where the wife is a partner has carried on the business. Supreme Court came to a conclusion that when based on clubbing provisions, if you are assessing the share of income of the wife in the hands of the husband, then you have to grant him deduction, you have to grant him set off of the losses. So this was again a departure from the literal interpretation rule. The third maxim is benignor sententia in verbis generalibus su dubis est preferenda. The most favorable construction is to be preferred in general or doubtful expressions. Application of this maxim would arise when, on interpreting a particular provision, the court comes to a conclusion that there are two views which are possible on this particular issue. In those circumstances, according to this legal maxim, one has to prefer the view in favor of the assessee, which is in favor of the subject. One very recent live example where this principle has been applied is one very controversial issue about whether payment for software would tantamount to royalty. According to the department, such payment is for license to use copyright. According to the assessee says that I am actually making the payment for purchasing a product which is the DVD or the CD or the medium in which the software is. Therefore, it cannot be regarded as royalty. Karnataka High Court in Samsung Electronics 345 ITR 494 upheld the departmental view. And there are various other decisions from the Karnataka High Court on this issue. Delhi High Court took a view that such payments cannot be regarded as royalty. So there was a conflict between the Karnataka High Court and the Delhi High Court. There are various decisions in the tribunal where, apart from merits of the matter, when it came to this conflict of views, the tribunal has come to a conclusion that the most favorable view in favor of the assessee has to be taken. That is one of the principles, though they decide on the basis of the merits of the matter. Other well-known decision on this particular issue is in the case of Vegetable Products Limited, 88 ITR 192, where the Supreme Court was concerned with Section 271(1)(a) of the Act and what is the meaning to be given to tax. And they have come to a conclusion that tax payable is the tax which is referred to in the provision and not the tax assessed, which was the basis for quantification of penalty. Next maxim is expressio unius est exclusio alterius. That is, express mention of one person or thing is the exclusion of another. This could be relevant in different types of scenarios. Like, for example, general rule for assessing capital gains is where gains have to be assessed based on the full value of consideration. Section 50C makes an exception where the stamp duty value could be taken as the full value of consideration. So this is an example of express mention of one thing is exclusion of another. So this principle, that is substitution of the stamp duty value or some other value other than the full value of consideration, is possible only when there is a specific mention made. And only to such scenarios, you cannot extend it to any other scenario. Similar position would prevail under section 56(2)(7) when certain money or in kind or any thing in kind received by the assessee without consideration or for less than the consideration, which is again a burden, so it would apply only to those type of cases and not to others. Then section 214 defines capital assets and makes an exception that an agricultural land would not be a capital asset as per clause 3 below section 214. In this agricultural land, there is a exclusion carved out to which the exemption would not apply, which is when the land is situated in a certain jurisdiction or where the population is above a certain limit. So this is again for denying a benefit, some part is excluded and therefore such exclusion should apply only to that person. Next is generalia specialibus non derogant. That is, a special provision will override a general provision. This maxim will have application where there are two different provisions occupying the same field, and there is a conflict between the two provisions. In such a situation, it would be the court's duty to first attempt to reconcile the provisions, and if a reconciliation is possible, then to give effect to both the provisions. However, a situation could arise where both the provisions are irreconcilable. In that situation, this maxim would suggest that the court has to identify which is the general provision and which is a special provision. And in such circumstances, general provision will have to give way to the special provision. For example, under section 43B, contribution to a gratuity fund is to be allowed on payment basis. Under section 40A(7), no deduction is allowed in respect of provision for payment of gratuity. Clause B of 40A(7) says that clause A would not apply where the provision is made towards contribution to an approved gratuity fund. If one goes by 43B, provision can never be allowed because deduction can be allowed only based on actual payment. 40A(7) clause B says if it is a provision for contribution to an approved gratuity fund, deduction can be allowed. So there is a conflict between these two provisions, irreconcilable. Court will have to identify which is a special provision and then give effect to it. One more such scenario arose before the Mumbai Tribunal in the case of Metchem Canada, 100 ITD page 251. This was a case of a non-resident company which had incurred general and administrative expenditure for the head of general and administrative expenditure which were incurred by the head office or the branch office in India. India-Canada treaty was applicable. As per the treaty, if there is a permanent establishment in India, profits have to be computed based on Article 7. Article 7 made a specific provision with respect to limitation on the deductions to be allowed, where there was a provision in the domestic law placing such limitation on administrative and general administrative expenditure. So according to Article 7, 44C, which is the limitation provision, would become applicable. There was also Article 24 in the treaty which was on non-discrimination. Assessee's argument was, insofar as a resident assessee is concerned and general and administrative expenditure incurred for branches, there is no disallowance prescribed for as under 44C. This disallowance is only for non-resident assessee having a branch in India. So this tantamounts to a discrimination which is not permitted according to the treaty. So the tribunal was faced with a situation where Article 7 in the treaty says limitation in the domestic law would apply. Article 24 of which the interpretation says that such discrimination, this is discrimination and cannot be allowed. And the tribunal has come to a conclusion that Article 24 is the special provision which would be applied and Article 7 will have to give way to it. I am giving this illustration so that we can understand the maxims and we can relate to it. Next is the maxim of casus omissus. Omission in legislation cannot be supplied by the courts. fundamental rule: law is to be framed by the legislature, judges are only to interpret it. So, if a situation arises where the court comes to a conclusion that the provision in the act is not fully effective, in that situation what is to be done? As per this principle, the court has to close its eyes and say that the provision will become inapplicable because it is not complete. One illustration where the situation arose was in the case of Nalini Kant Ambalal Modi, 61 ITR 428, Supreme Court. Assessee was a practicing advocate who was elevated as a judge of the High Court. For his professional receipts, assessee was following cash method of accounting. There were certain outstanding receipts which were receivable at the time he was elevated as the judge. After his elevation, he received those amounts. Issue arose whether these amounts could be brought to tax. Supreme Court came to a conclusion that this cannot be. Subsequently, to meet this particular scenario, Section 176 subsection 4 was brought in the 1961 Act, because N.A. Modi was a 1922 Act scenario. So 176(4) was brought in the 1961 Act to say that whenever there is a discontinuance of a business or profession, and after the discontinuance of the profession, any amounts are received, then the receipt would be chargeable to tax in the hands of the recipient and in the year in which the amount is received. So a case arose before the Calcutta High Court in the case of Justice R.M. Datta, 180 ITR page 86. This was again a similar scenario: advocate elevated as a judge of the High Court and outstanding receipts, amounts received, outstanding fees received. Court came to a conclusion that yes, chargeability is there because chargeability would be in the hands of the recipient and in the year in which the amount is received. However, at present, the assessee is the judge of the High Court. You can assess the amount under the head business or profession if a person is carrying on profession. Here admittedly he is not carrying on any profession, so you cannot assess it under the head business or professional income. Since this is in the nature of business or professional income, you cannot assess it under the head other sources. So therefore they came to a conclusion that 176(4) falls short of under which head the income is to be assessed, and therefore came to a conclusion that the receipt is not taxable. So though there were amendments made to take care of a situation, amendment was held to be incomplete. So this is a case of casus omissus, where the court says that I will not look beyond what is there. Exactly opposite is the next maxim: casus omissus et oblivioni, that is dispositioni communis juris relinquitur. A case omitted and consigned to oblivion is left to the disposal of the common law. So according to this maxim, if some such situation arises, then it is the duty of the court to apply the principles of common law and give effect to the provision, and not place the provision in a situation where it becomes inapplicable. Friends, one interesting thing which came out was that though these legal maxims are there, they are not something like a perfect science These are not scientific tables in the sense of if so and so plus so and so would become so and so. So there are always exceptions, and you would find that the same principle or maxim would have exceptions, and you would be able to twist it in the manner in which you want. It will all depend upon what the court or what the judge wants to do. So this was a case where Manjula Shah, 355 ITR page 474 Bombay, where the fact situation was an earlier owner had acquired a capital asset in year 1. The earlier owner gifted the asset to the assessee in year 4. Assessee transferred the asset in year 7. Admittedly giving rise to capital gains, long-term capital gains, indexation available, no dispute. Issue was from which date the indexation is to be allowed. According to the department, it should be year 4 because the assessee received the gift in year 4. Assessee was arguing that it should be year 1. And explanation below section 48, which grants this benefit of indexation, makes a reference to index for the year in which the asset was first held by the assessee. So issue was, when did the assessee come to first hold the asset? Assessee's argument was that under explanation 1 to section 242A, period of holding of the donor is considered as my period also. So give full effect to it. Bombay High Court has looked into this situation and granted indexation from year 1. Another interesting situation arose before the Supreme Court in National Taj Traders 121 ITR page 535. This was a case where an appeal had arisen from a 263 order or revision order passed under section 263. Tribunal came to a conclusion that in the appeal against the 263 order, that there is a possibility that the order could be regarded as erroneous and prejudicial, the assessment order, so therefore the commissioner would be justified in invoking this jurisdiction. However, there was one defect in the commissioner's order. Commissioner had not complied with the principles of natural justice. So tribunal could not uphold the 263 order. So therefore, tribunal was considering whether I can remand back this matter to the commissioner. Assessee's argument was under section 263 subsection 2, an order can be passed by the commissioner under the said section within a period of 2 years from the end of the financial year in which the assessment order was passed. That period is over. So therefore you should not send it back, because otherwise you are extending his limitation. The tribunal came to a conclusion that my powers are to pass order as I think fit, which would include that I have the power to remand. There is a difficulty with respect to 263(2), but they supplied that difficulty and remanded the matter, which was upheld by the Supreme Court. Next is maxim in the case maxim contemporanea expositio est optima et fortissima in lege. Interpretation of a statute by referring to the exposition it has received from contemporary authority. According to this maxim, the objects and the reasons when the particular act is brought out have relevance for the purposes of interpretation of that act, because that is an exposition given by the competent authority on that particular provision. Insofar as the Income Tax Act scenario is concerned, every year we have the finance bills and the finance acts coming in. Along with the finance bill, we have the notes on clauses and the memorandum explaining. According to this maxim, we can make reference to the notes on clauses and the memorandum explaining for the purposes of interpreting the provision if there is some ambiguity about it. Similarly, the circular explaining the provisions issued by the CBDT would also be a relevant factor which would be covered by this particular maxim, which is contemporaneous exposition.
So you mean to say once the bill is passed and it becomes an act, for interpreting a certain section, you can refer to the notes and the
memorandum explaining and the circular explaining the provisions which is issued by CBDT. Next maxim is Nova constitutio futuris formam imponere debet non praeteritis. Every statute is prima facie prospective unless it is expressly or by necessary implication made to have a retrospective operation. Very clear that the provision will have to be given prospective effect and not retrospective unless it is specifically provided. I don't think there could be much controversy on this particular proposition. However, issue would arise where, in what circumstances, even though there is no specific provision, a retrospective operation could be given. Those exceptions are if it is a provision dealing with procedural law as against a substantive law, then it will apply to all pending proceedings. The manner in which you distinguish between a procedural law and a substantive law is if that provision imposes a liability or creates a liability, then it is a substantive provision. Otherwise, it would be a procedural provision. Supreme Court in the case of Shravan Kumar Swaroop 210 ITR 886 came to a conclusion that a rule of valuation, Rule 1BB, was a rule of evidence and therefore would be a procedural provision because according to them, wealth tax would be chargeable based on value of asset. And the rule which was prescribed was a recognized method of valuation and therefore no change was brought in and therefore it was a rule of procedure. There could be other type of cases where retrospective effect could be given, which is where a particular amendment is clarificatory. Here the example could be Supreme Court decision in the case of Gold Coin Health Food Private Limited 304 ITR 308. This was a case where the assessee had returned a loss. He was assessed based on loss. So the assessee's argument was that since this is a situation where it is loss to loss, so therefore there should be no penalty. And at that point of time, explanation 4 had some ambiguity in it, which was subsequently clarified by the legislature. And the issue involved was that whether the clarification would be retrospective or prospective. And the Supreme Court came to a conclusion that this is how the legislature always intended the provision to be. And therefore, it has to be given a retrospective effect. Other well-known situation where retrospective effect has been given would be where the amendment is a curative amendment. For example, the situation which arose before the Supreme Court in the case of Allied Motors Private Limited 224 ITR 677, which was in the context of 43B, and proviso to section 43D provided that if a particular payment is paid before the due date of filing the return of income, then deduction has to be allowed. And Supreme Court came to a conclusion that though this amendment as per the Finance Act is prospective, but since it is curative in nature, it has to be given retrospective effect. I think reference should also be made to section 295 subsection 4, which is on power to make rules, which has been given to the central government. And this subsection says that power to make rule shall include the power to give retrospective effect to the rule. Unless the contrary is permitted, no retrospective effect shall be given to any rule so as to prejudicially affect the interest of the assessee. So, retrospective effect cannot be given to any rule if it prejudicially affects the assessees. Next is the maxim of leges posteriores priores.
Calling is for removal of doubts, but as you rightly said, unless it is expressly given a particular date, still it can't apply, even if it is for removal of doubts.
So for removal of doubts, one will have to see whether it falls within clarificatory amendment. So if it falls within clarificatory amendment, then it can be given retrospective effect also.
Example where it cannot be given is that depreciation that you took.
Explanation 5 to section 5.
An amendment which are clarificatory in nature are having a retrospective. Now there are always a question of whether this is a clarificatory amendment or whether it is a non-clarificatory amendment. Can you please throw more light on that? When we should consider it to be a clarificatory in nature?
No, so the thing would be, as in the case of section 271 1C, loss to loss, whether there could be a penalty. There were amendments made in the provision which were in 3 stages, in the sense of earlier there was a particular provision, subsequently an amendment was made. It was found that the amendment which was made was not complete and therefore a third amendment was made. In this situation, where the legislature always intended it to be a situation where penalty should be levied, however, there was a doubt with respect to the manner in which the amendment had been made, and when they are clarifying that amendment, it would be regarded as clarificatory, because that was always the intention of the legislature that this should be done, and in that situation it would be regarded as a clarificatory amendment. So where the legislature always intended that this should be the position, however the provision which was there was not effective to meet that situation, and therefore an amendment is brought in. That is a clarificatory amendment. Next is leges posteriores priores contrariores abrogant. Later law repeals earlier law inconsistent therewith. Again, a simple proposition that the later law would prevail over the earlier law. However, there could be an exception to this, as was the situation before the Supreme Court in the case of Shah, Sadiq and Sons, 166 ITR 102. This was a case where for assessment years 1960, 61 and 61, 62, which is what was covered by the 1922 Act, assessee had incurred speculation loss. As per the provisions as they then stood, assessee could have carried forward those losses. Assessee was a partnership firm. Subsequently, the 1961 Act comes, where there are certain restrictions on partnership firm or special provisions made. In EY 1962-63, which is after the 1961 Act came in, which would mean that the 1922 Act would now not survive, the assessee made a gain in speculation business, and wanted to set off the brought forward speculation loss against the gain. According to the department, since there was no enabling provision under the 1961 Act for this purpose in the case of a partnership firm, this set off would not be allowed. Assessi's argument was that as per the earlier provision, I have a vested right, and since I have a vested right, that right will have to be given effect to though the provision is no longer there. So this was a case where it is an exception that the later law would make the earlier law, which is inconsistent, to be inoperative. Next is the phrase non obstante, which we find very often, which we find on several occasions in a particular statute. This particular phrase becomes relevant because there would be a certain basis on which a particular act would proceed. There would be a flow of provisions. However, if a departure is to be made or a diversion is to be made from the regular provisions, the legislature has to introduce a non-obstante provision, which is notwithstanding anything to the contrary contained in section so and so or anything in the act, the position would be so and so. So examples of this could be where presumptive basis of taxation has been prescribed, like section 44 AD, ADA, AE, etc., where the provision would start with notwithstanding anything to the contrary contained in sections 28 to 43A, so and so, income has to be computed on the basis of presumption. Other situation is something like section 50, where normally if you have held an asset for more than 36 months, it would give rise to long-term capital gain. Section 50 deals with depreciable assets and says notwithstanding anything to the contrary contained in section 242A, capital gains arising from depreciable assets would be chargeable to tax as short-term capital gains. So this is an exception. So something like a diversion which you are taking from the normal rule. Other example could be provisions like section 115JB or 115JC, where income is to be taxed based on book profits. So this is again notwithstanding anything contained in the act, so and so provision will apply. Next phrase is mutatis mutandis, which means that when a law directs that I'm sorry, I'm not clear.
Suppose there are two provisions which begin with non-obstant clause. So how do we harmoniously interpret those two provisions?
And both the provisions would be covering the same field.
Yes.
In that situation, one will have to apply the earlier maxim, generally a specialibus non derogant. So one will have to identify which is the general provision and which is the special provision. And the special provision will prevail over the general provision. Next is mutatis mutandis, which says that when a law directs that a provision is made for a certain type of a case shall apply mutatis mutandis in another type of a case, it means that it shall apply with such changes as may be necessary. So this situation arises where rather than making detailed provisions in respect of a certain issue, the legislature makes a reference to some other provisions, in which situation the other provisions would apply as far as may be applicable. So this is what is meant by mutatis mutandis. Next phrase is perimateria, which means reference to other statute dealing with the same subject or forming part of the same system. This situation would arise where supposing if you are concerned with a particular provision which is placed on a similar basis under the Income Tax Act and also under maybe the Excise Act. If the provisions are perimeteria, what you can do is judgments which have been given under either of the acts could be applied for interpreting a provision in the other act. For example, there could be that in what circumstances an assessment order could be rectified and the language used is the same in both the acts, which is the mistake apparent from the record. Then you can use judgments under the other enactment for the purposes of interpreting this particular enactment. Similar situation could arise when there are provisions for revision or things like provisions where enabling powers have been given to the tribunal or to the High Court for admission of additional evidence or admission of additional ground, where provisions are similarly worded in two different statutes. The judgments in the other statute could be used for the purpose of interpreting this particular statute. This is a comparison which I made inter se between two statutes. However, there are also occasions which arise where you can also rely upon judgments which are delivered by courts of other countries if the provisions are perimeteria. Then one of quite common situation which arises is when we are concerned with DTAAs, the make available clause for fees for technical services. So wherever, on several occasions we have seen wherever this particular phrase is to be interpreted, though we are not concerned with India-US treaty, we apply the memorandum of understanding as given in the India-US treaty for the purposes of interpreting those provisions, because the provisions are perimeteria and the interpretation which has been placed on one of the provisions would be applicable to the other. These were certain rules of interpretation. Now we go to the heading rules dealing with equity. Equity would mean that a particular proposition or a principle is based on justice, logic and good conscience. So there is no law with respect to it, but it is based on justice and good conscience. Insofar as taxation is concerned, well settled principle that equity and taxation are strangers. There is no place for equity in taxation, with certain exceptions, as we saw the KP Varghese or the Gotla's case. So equitas defectus supplet means equity supplies defects, and equitas erroribus medatur means equity rectifies errors. Next is certain principles with respect to interpretation of entries. The principle of adjustum generis, which means of the same kind or species. This principle has application where general words are associated with specific words. In which situation, if there is a genus which goes through or which could be identified through all the specific words, then that genus should also be applied to the general words, and you cannot give a wider meaning to the general words. Situation could arise, for example, as before the Supreme Court in the case of Techno Shares and Stocks Limited, 327 ITR 323, which was concerned with depreciation on membership rights in stock exchange. Depreciation is allowable on intangible assets being know-how, patent, franchises, licenses, etc., including any other business or commercial rights of similar nature. Supreme Court came to a conclusion that membership rights in stock exchange would be regarded as a business or commercial right of a similar nature, and its meaning will have to be taken from the phrase license, because by virtue of the membership, the person who is a member is entitled to trade on the stock exchange. This very phrase or this very provision has been again interpreted by the Supreme Court in Smith's Securities 348 ITR 302, where depreciation has been granted on goodwill as an intangible asset, applying this principle. When we are considering this principle, it is very important that one has to find a genus which is going through all the specific words. Unless that test is fulfilled, one will not be able to apply this principle. And it is very important that that particular aspect should be identified. To highlight this, the decision of Pune Special Bench in the case of Dhariwal Industries Limited, 111 ITD 379 may be relevant. This was concerned with the case where assessee was manufacturing gutka, pan masala, and it was claiming deduction under section 80IA or 80IB. As per that provision, if the assessee is manufacturing any of the items listed in the 11th schedule, the benefit under those sections would be allowable only to the SSIs. And one of the items in the 11th schedule was tobacco and tobacco preparations such as cigars and cheroots, cigarettes, beeries, smoking mixtures for pipes and cigarettes, chewing tobacco and snuff. Assessee's argument was one has to apply this principle, and the common genus which is running through all these items is that in all these items the main ingredient, whether you go by quantity or you go by value, is tobacco. And insofar as pan masala or gutka is concerned, tobacco is not the main ingredient. However, the special bench came to a conclusion that I accept that this principle is applicable, but according to me, the genus which is running through all these specific words which have been mentioned is the tobacco effect. Whether you smoke or you use tobacco in any other form, or you chew gutka, it has the tobacco effect, and therefore it would be covered by this particular entry. So what I want to emphasize is that genus, identification of that genus is important. Next is Nosita Asoki. The meaning of the word is to be judged by the company it keeps. More or less on the same lines as the earlier maxim. Here also, just to give illustrations, there was a situation which arose before the Bombay High Court in Caltex India Limited, 177 ITR page 239, where development rebate was to be allowed on plant and machinery used for manufacture or production of article or thing in 5th schedule. Similarly, ATE deduction was also allowed for profits from manufacture or production of article or thing in the 5th schedule. And one of the items in the 5th schedule was coal, lignite, iron ore, bauxite, manganese ore, dolomite, limestone, magnesite and mineral oil. Assessee was manufacturing lubricating oil. An issue arose whether the assessee's case would be covered by this. The High Court came to a conclusion that if at all it would be under mineral oil, but the meaning which is to be given to mineral oil should be based on the associated words which are there, which is such type of minerals which are extracted and not minerals on which some processing has been carried out, and therefore the assessee's case would not be covered. One more example, though, which was a situation which arose before the Supreme Court, though the said decision is no longer good law, but just as a matter to explain the provision, in the case of Vanya Silk Mills Private Limited, 191 ITR 647. The said decision is no longer good law, but I am just using that for explaining the provision. That was a case where assessee had received insurance proceeds upon loss of asset. An issue was whether capital gains could be charged. Court came to a conclusion that the phrase transfer has been defined as meaning sale, transfer, relinquishment of any asset or extinguishment of any rights therein. When you are concerned with sale, exchange or relinquishment of the asset continues to exist. In the case of loss of asset where I am receiving insurance proceed, you have to interpret extinguishment of any rights therein would mean that the asset should exist, continue to exist, and there is an extinguishment of right in that particular asset. The Supreme Court in that case upheld the assessee's case, saying that the asset should continue to exist. However, as I mentioned, by virtue of the Supreme Court decision in Grace College, that decision is no longer good law, where the Supreme Court says that existence of the asset is no longer required. But this is only to explain that this is how a genus is identified, a common string is identified, and the relevant entries are interpreted. Next are certain maxims dealing with administrative proceedings. The maxim is Audi alteram partem, which means no man shall be condemned unheard. This particular maxim is based on the fundamental principles of natural justice. There are various facets to this principle. One is that before any order is passed or before any action is taken against a person, he is entitled to a show cause notice. And such notice should be clear on the case which has been made out against that person. Plus, whatever material is sought to be relied upon against that person should be made available to him. The second stage is, or aspect is, that the person should be heard, where he should have liberty to put forward his argument as to why a particular action should not be taken against him. Also, if statements of some persons are relied upon, he should have a right to cross-examine those persons. And the third most fundamental thing is that if an order is passed against him, then that person should know what are the reasons for which an order is passed against him. So these are the three fundamental things with respect to principles of natural justice. First is, he should be made known as to what is put against him. He should have a right to be heard. And third is, he should be provided reasons as to why a particular action is taken against him. Next maxim is delegata potestas non potest delegere. A delegate cannot further delegate. This is a principle of civil law dealing with agency, which says that an agent cannot further delegate to a sub-agent unless he has such authority. In the context of income tax provisions, this particular maxim would be relevant where, for example, section 132, where authorization for search has to be given by certain designated officers, specified officers. Legislature has delegated that authority to those officers. Those officers cannot further delegate that authority to someone else. Similar situation could also arise where before reopening an assessment, if it is an assessing officer below a certain rank, or if the reopening is beyond 4 years, sanction is to be taken from the Joint Commissioner. That is also a power which is to be exercised by the person to whom the authority has been given. That authority cannot delegate that power to anyone, and not even to his superior, which has been held by the Bombay High Court in Ghanshyam Kabrani, 346 ITR 443.
So like in the case of IDS scheme that was going on, the power was given to principal commissioner or the commissioner, but they delegated to joint commissioners to accept applications and all. So that was void.
So, I don't know, one will have to really see in the context, because if there is an enabling provision given to the person to further delegate, he can do it. But if there is no enabling provision in him, it won't be possible for him to delegate. Then it is he who has to carry it out.
He's saying that issue which is to accept that forms.
Okay.
Only basically
Practically, everybody they were knowing
in IDS normally they were accepting in the seal level.
survey proceeding, they were taking the
That is eminent. That is eminent.
I guess also they were accepting open market.
When I went, they said no. Anyway.
Every commissioner.
Practically.
Next are certain categories of maxims which have evolved in the context of court-related matters. First is stare decisis. This has been a part of discussion by other co-speakers. This particular maxim means when a point of law has been settled by decision, it forms a precedent. That is, if a view is taken in a certain fact situation based on a legal position, then that view should be followed in all later cases where similar facts exist and legal issue arises. The benefit of this is that people are able to certainly take a call on a particular issue in the sense of there is certainty. But the other side is that if in a later decision the earlier decision is to be followed, then how will there be development of law? So it is only when you look upon a particular aspect of a matter from different perspectives, will there be a difference of opinion and there be a development of law. So this is just the one more other side. I am not saying that there should be not a situation where the later court should not follow the earlier decisions, but there are advantages as well as there are disadvantages also. Next is res integra, which is a phrase where a particular point arises on which there is no precedent which is available. So this is a neat or a pure issue which arises on which there has been no precedent in the past.
Development of law can happen in the higher court.
Appreciate, but we should also appreciate that we are staying in a country where the High Court takes 15 years to decide from the filing of the appeal, and Supreme Court takes another 5 or 7 years. So, effectively, as of today, you cannot wait for the High Courts and the Supreme Courts to decide. Next is the principle of per incurium. As I earlier stated, the principle is that judgments of judicial authorities higher in forum would be binding on those authorities who are lower in the hierarchy. So, for example, Supreme Court decision would be binding on all courts within the country. High Court decision would bind the courts within the particular state. Tribunal decisions would bind the commissioner or the commissioner of appeals and the assessing officer. Per incurium is the principle by which an authority lower in rank can justify not following a judgment given by an authority higher in rank. And such cases would be where the court, the higher court, has decided the issue without referring to the relevant provision or in ignorance of binding judgments. So if the decision of the higher court is in ignorance of the relevant provision or in ignorance of binding judgments, then the decision of the higher court would be regarded as per incurium and it would be open to the lower authority to not follow it. However, such situations should be rare, because otherwise it would be all anarchy and there would be no direction.
Just a question. Who decides that, who ultimately comes to the conclusion that this decision is per incurium?
No, so the lower, for example, if there is a decision from the High Court and the tribunal is considering the very same issue, and tribunal comes to a conclusion that the High Court has not considered a particular provision or has not considered a particular judgment, and therefore the High Court order is per incurium, it has to be the tribunal who will have to decide this. So the person who has to take a call on that particular issue will be the person who will have to hold the decision to be per incurium.
Here, quite a few times, like when my client has a positive judgment from High Court, still the assessing officer and CIT appeals go against it. Does that
No. There could be different reasons for that. Per incurium is a principle which has to be applied in rarest of rare cases. It cannot be that you designate anything as and everything as per incurium. The stand which the assessing officer takes would be based on that if he does not take this stand, and supposing in further appeal against those earlier judgments, if Supreme Court takes a different view, then the assessing officer with passage of time would be left with no option. So therefore, to keep the issue alive, he has to take a certain position. But that does not mean that he is taking that position because according to him, the decision of the appellate forum is purring to him. This is a principle to be applied rarely.
What suppose it's the Supreme Court's larger bench, they are not referred to the smaller bench. Then still the larger bench will be binding.
Larger bench would be binding.
Whether they are
Because lower bench would not be binding on the larger bench. But supposing if there was a division bench decision earlier, subsequently another division bench takes a different view without considering the earlier view, then the later decision could be said to be per inclusive because you have not considered an earlier binding judgment. Next is the principle of sub silentio, which means a decision on a particular point of law was not perceived by the court or present to its mind. This is also a principle where a precedent may not be applicable. Such situation would arise where, for example, if 2 points are arising in a particular case, say point A and point B, the earlier judgment reaches a particular conclusion based on point A, does not consider point B. In a later judgment, one can argue that the earlier decision has been passed sub silentio because point B has not been considered by the earlier judgment. As an illustration, before the Supreme Court, a situation arose in the case of Narang Overseas Private Limited, 111 ITD page 1, Mumbai Special Bench, where the assessee had received mean profits. Mean profits is where the court grants you damages for unauthorized use of your property. Issue was, assessee was arguing that mean profits is not chargeable to tax. Department's argument was, Supreme Court in the case of Mariappa Gaunda, 232 ITR page 2, had held that mean profits would be chargeable to tax in the year in which the litigation in which the mean profits are arising attains finality. So therefore, department's argument was, when the Supreme Court says that it would be taxable in the year in which the litigation attains finality, so therefore it is taxable. Tribunal said that there are 2 different points. One is whether the receipt is taxable. The other point is, if it is taxable, in which year it is taxable. Whether the receipt is taxable is the issue which was not considered by the Supreme Court. So therefore this was a decision sub silentio. So therefore that particular issue could be considered by the tribunal, and they considered that issue and said that it will not be chargeable to tax. Next is the principle of actus curiae neminem verabit. An act of the court shall prejudice no man. This principle would be relevant when we are concerned with rectification related proceedings. So supposing if a particular appellate authority has decided an issue based on misunderstanding of certain fact or legal position, or there is a defect in the procedure, for example where the assessee had filed additional ground or had filed additional evidence where the necessary procedure has not been followed by the court for considering admission or rejection of that particular evidence or additional ground, or if natural justice principles have not been followed, which causes prejudice on account of the court's action, then in such situations the court should take necessary steps so that that prejudice is removed. In this scenario, one decision of the Supreme Court would be relevant. Honda CL Power Products 295 ITR page 466. This was a case where tribunal had decided an issue overlooking an earlier judgment in the assessee's own case by another coordinate bench of the tribunal. And applying this principle, the tribunal had recalled the order because this was an act on the part of the tribunal which was causing prejudice to the assessee. And the Supreme Court has said that such recall of the order was valid.
It will also be helpful for 46A situation, 46A, where the person has not been able to file the evidences to the assessing authority and wants to file it for the first time. Will this be helpful in
No. When I mention additional evidence, it would be that assessee had placed certain additional evidence before the tribunal for consideration. Tribunal did not consider it and independently decided the issue. In that situation, because of an action on the part of the tribunal, the assessee is being prejudiced. So, otherwise, generally this will not be right. Next is judicis est dicere non jus dare. It is the province of a judge to declare the law, not to make it. We again come back to the first proposition which we started, which is the principle of golden rule or the literal construction. Next is very important principle of res judicata. This particular principle applies where there is a litigation between same parties where same question is involved, which question has been decided by a court having competent jurisdiction, and that particular decision has become final. In that situation, this principle res judicata says that the same issue cannot be raised over and over again. So therefore, there should be finality to proceedings. However, it is well settled that the principles of res judicata does not apply to income tax proceedings because each year is different. However, the principle which would apply is that there should be consistency in the approach taken. For example, as was the issue as arose before the Supreme Court in the case of Radha Swami Satsang 193 ITR 321, where they said that res judicata does not apply to income tax proceedings, but there should be consistency. So there the issue was, assessee had been granted charitable status for several years, and all of a sudden in middle, the revenue says that you are not a charitable institution. Supreme Court said that there should be consistency in the approach, and therefore the charitable status cannot be disturbed. There could be various situations where this consistency principle could arise. For example, what would be the stage of accrual of income? In the case of export incentives, such stages could be when you have fulfilled the conditions which would entitle you to the benefit. Stage 2 could be where you have made the application. Stage 3 could be where you have received the necessary certificate. And stage 4 could be when you have availed of the benefit. Whatever view the department takes on what stage the income would accrue, it should be consistently applied over the years. There could be other situations also where this principle would be relevant. And there would be one exception to this principle of consistency, which is if the department is able to show, or the assessee is able to show, because it can work both ways, that there is a change in the factual situation or the legal position. In which situation the consistency principle will not apply. Next is certain principles under the penal law. Ignorantia juris non excusat. Ignorance of law is no excuse. This is a general law principle that everyone should know the law. But with respect to a branch of law like income tax, where each year there are finance acts making several amendments, there being provisions like 80 HHC where there are amendments after amendments and different views expressed by different benches and different courts, certainly an SSC cannot be expected to be aware of all the laws. So certain exceptions have been made on in terms of the penalty related provisions. Next is de minimis non curat lex. Law does not concern itself with trifling matters. So if there is a technical or a venial breach which does not affect the tax liability, then there should not be any adverse consequences arising out of it, because this would be just a trifling matter.
What's the second one you use? If there is technical or
Venial breach. In this particular category, we can also place those cases where the CBDT has taken a view that if the quantum involved in the appeal is below a monetary limit, then therefore they would not want to pursue that appeal, because these are small amounts and we don't want to go into these issues. Next are the maxims of suppressio veri and suppressio veri expressio falsi. Suppressio veri means suppression or concealment of truth, and suppressio veri expressio falsi means suppression of truth is equal to expression of the false. So this would be relevant to a situation where the department is alleging that the assessee has concealed the particulars of income, that is, he has suppressed certain relevant facts. Next is suggertio falsi, false representation, which is where positively a false statement is made, and this would be relevant for the other part of 271(1)(c), which is where the allegation is that the assessee has furnished inaccurate particulars of income.
In context to the observation reporting,
The Supreme Court was not concerned with concealment of income. They were
they observed that yearly meeting making a wrong claim does not amount to a
So there the department's allegation was that you have furnished inaccurate particulars of income, and the Supreme Court says the department has to identify the particulars of income and then show how those particulars of income have been inaccurately furnished by the assessor.
That was a case of concealment.
That was not a case of concealment. So it will all depend upon facts of the case, but I am just identifying that this is a maxim which will have relevance for us.
you have a judgment where this is used, this expression is used?
Not in the context of income tax. Next is certain miscellaneous phrases. So de facto and de jure. De facto would mean in reality or in fact. and de jure would be according to law or by convention. The relevance of these phrases would be while considering the residential status of a company. Section 6(3) up to 31st March 2017 said that a company would be resident in India if the control and management of its affairs is situated wholly in India. From 2017, the provision has been amended to say company would be resident in India if its place of effective management in that year is in India. And place of effective management has been defined to mean where key management and commercial decisions that are necessary for the conduct of its business as a whole are in substance made. So, in this context, the proposition would be that control and management of the affairs or effective management is with the board of directors, which is the de jure control, that according to law, normally the control is with the board of directors. And the place where the control and management are situated or the place of effective management would be where the meetings of the board of directors are held, where such decisions are taken. De facto would mean where the revenue is able to show that though in law it is the board of directors who have to take the decisions, but they are acting on the directions of someone else. So that person is in de facto control or in fact or in reality in control. So this is the context in which these two provisions would be relevant, these two maxims would be relevant. Next is a general maxim, debitum in presenti solventum in futuro, a debt due at present to be paid in future. For an income to come within the scope of total income, one of the criteria is its accrual. And accrual would mean right to receive. It is in that context that this maxim would be relevant, where though you have not received it, but you have a right to receive it. So a debt due at present, which will be paid in future, would be regarded as having accrued. Next is the maxim of impotentia excusat legem, the impossibility of doing what is required by the law excuses from the performance. So if a particular requirement of the law is impossible to be performed, then such requirement should be excused. This situation could arise, for example, in an 80-ID-10 scenario where deduction is claimed in respect of housing projects. A project would be regarded as complete when certificate to that effect is issued by a local authority. Now supposing if a developer has completed the housing project, but on account of some technical reason the local authority is not issued. Now that is not in the control of the developer. In that situation, whether this particular proposition could be extended, that I have done whatever was required to be done, the project is complete in all respects, but because of this supervening difficulty, I don't have the certificate. Second is interest under section 234B, which is levied for a shortfall in payment of tax. Supposing if a particular item of income is made taxable by virtue of a retrospective amendment, I could not be expected to foresee that such and such amendment would be made in future and therefore I should pay the tax. So this could be also a situation where it is impossible of performance. Another example where this particular maxim may be relevant is section 54, where capital gains arising from transfer of a residential house is exempt if you purchase another house within a period of 2 years from the date on which the transfer took place. So supposing if an assessee sells a particular residential unit and books another residential unit with a developer, assessee is doing everything from its side, but there is a delay on the part of the developer and within 2 years the unit is not complete. It is impossible to be performed on the part of the assessee. So such circumstances also, this particular Hilavadia, 216 idea. Last is vigilantibus et non dormientibus jura subvenient. Law assists those who are vigilant and not those who sleep over their rights. This particular maxim would be relevant in the context of condonation of delay. So supposing if a particular application or appeal is delayed, then this particular maxim may be put against you, that if you are not vigilant or if you are sleeping over your rights, then the law would not help you. Or if you are entitled to a benefit, but if you don't claim it, then again you may have to suffer. So friends, these were few maxims which I had identified, and I hope I have been able to explain this and correlate them with the provisions of the Act. Thank you for listening. Before time.
Well, friends, not before time or not within, it's perfectly on time. Then friends, we are coming to the end of this